All right, let's get right into it. For years, pretty much every investor has been obsessed with one single question. How do I beat the market? But what if that's completely the wrong question to be asking? In this explainer, we're going to tackle something way more important. It's about how to conquer the only market that really matters, the one that's right inside your own head. It's about mastering your own risk before the market decides to teach you a really, really hard lesson.
So let's start with a question that honestly is probably the most common and the most painful one out there for investors. Why do so many people with good intentions, end up losing their hard-earned money in the stock market? What's going on here?
I mean, this scenario is just classic, isn't it? And it's so painful to watch. So picture this. Someone invests 10 lakh rupees into the PSX. The market does what markets do. It drops. Suddenly, their account is showing 7 lakh. And that's when the panic hits. You can almost hear the thoughts racing. I've got to get out. I need to sell before I lose everything. So they sell. And just like that, a temporary paper loss becomes a very real, very permanent 3 lakh loss. And you know what happens next, right? The market eventually bounces back, but they're on the sidelines having missed the recovery. See, this isn't a market problem. It's a human problem.
And that right there brings us to the core of this whole thing. Why investors actually lose money. The truth is, the biggest risk to your money, to your sarmaya, it's not a market crash. It's not some bad stock pick. Nope. The real enemy is usually the person staring right back at you in the mirror.
So what does that mean? It means the real battle for long-term profit, for that munafa, it's not being fought on the floor of the PSX. It's won or lost right up here, in your head. I'm telling you, mastering your own emotions through this whole process, it is the single most important skill you can possibly develop as an investor, period.
Okay, so let's dig into the why of it all. We really need to get a handle on the psychology of panic, because it's our built-in, hardwired instincts that so often trick us into making the absolute worst decisions at the absolute worst times.
First things first, we need to get one thing straight. Market crashes are a completely normal, totally expected part of investing. I mean, look at the history of the PSX. We had the global financial crisis in 2008, political uncertainty in 2017, the COVID crash in 2020, and when these things are happening, man, it feels like the end of the world. But history shows us time and time again, the market recovers. If you're in it for the long haul, you will see more crashes. But, and this is the important part, you'll also see the incredible recoveries that follow, inshallah.
Okay, now here is a really powerful, a really bunyadi concept you've got to understand. It's called loss aversion. And what it means is, well, psychologists have shown that the pain you feel from losing money is about twice as strong as the pleasure you get from gaining the exact same amount. Think about that. That's why that 3 lakh drop we talked about feels so gut-wrenching, so devastating. And that's what triggers that powerful, almost irresistible urge to just sell and make the pain stop.
And this quote, man, it just absolutely nails the problem. Think back to 2021, when the market was flying high. Everybody felt like a genius, right? Oh, I'm an aggressive investor. And then 2022 happened. Fear took over, and a whole lot of people discovered their real risk tolerance at the worst possible moment. It's so easy to be brave when you're making money. The real test, the only test that matters, is how you act when you're losing it.
Okay, so the big question is, how do you figure out your real risk tolerance before a crash comes along and forces the answer on you? That's what we're going to do now. Let's shift from the problem to the solution. I'm going to walk you through 4 really simple but essential tests to help you truly understand yourself as an investor.
Okay, ready? Here they are. We've got the timeline test, the sleep test, the reaction test, and finally, the regret test. Now, I know they sound simple, but trust me, they are incredibly powerful. By the time we're done with these, you're going to have a much clearer picture of the kind of investor you truly are. All right, let's start with test number 1, which is maybe the most important of them all. You have to ask yourself this question, and you have to be brutally honest with the answer. When do I actually need this sarmaya, this capital, back in my hands? Because here's the thing, your timeline is your single greatest shield against panic selling. Let's break it down. If you need that money in less than 5 years, maybe for a house down payment or something, then the stock market is just too risky. You should be looking at much safer options, like national savings or even just bank deposits. Now, if your timeline is more like 5 to 10 years, okay, some exposure to the PSX could be fine, maybe with a focus on stable, dividend-paying companies. But if you have 10 or even better 20+ years, well, my friend, you have all the time in the world to recover from any crash. Those short-term drops, they're not threats anymore. they become opportunities. Okay, next up is the sleep test. And this is a pure gut check. I want you to really imagine this. You invest 10 lakh rupees. You go to bed, you wake up the next morning, you check your account, and it's worth 6 lakh, a 40% drop overnight. Now, the question isn't about the math or the market. It's about you. Can you honestly sleep that night?
All right, test number 3, the reaction test. Let's stick with that same brutal scenario, a 40% drop. Now, forget what you think you're supposed to do. What is your immediate, first, gut reaction? Is it A, pure panic? That feeling of, I have to sell right now before this thing goes to zero. Well, that points to a lower risk tolerance. Or is it B, you're concerned for sure, but your thought is, okay, this is bad, but I'm just going to hold on for the recovery. That suggests a moderate tolerance. Or is it C, actual excitement? Are you thinking, wow, stocks are on sale, I'm buying more? That's a classic sign of a high-risk tolerance. Just be really honest with yourself here.
And finally, we have the regret test. This one is all about understanding what really drives you. So which of these two scenarios would feel worse to you? In scenario A, the market skyrockets up 30%, but you played it safe, so you only made 10%. Or scenario B, the market crashes 30%, and because you were aggressive, you lost 40%. Which one would you regret more? Which one would keep you up at night? If it's missing out on the gains, you can probably handle more risk. But if it's the pain of that big loss, you definitely need a more conservative plan. There's no right or wrong answer here. It's just about knowing what makes you tick.
Okay, so you've gone through the tests. You have a much better sense of your timeline, your gut reactions, your emotional triggers. So now what? Well, this is the most critical step of all. It's time to turn all that self-knowledge into a concrete, written-down plan. A plan that's going to act as your shield when fear comes knocking.
Because without a plan, this is what happens. Your portfolio just becomes a random, tangled collection of stocks and funds. There's no strategy, no purpose. It's like a financial junk drawer. And trying to make sense of that mess when you're under pressure, it's pretty much impossible.
Now, let me be super clear. This is not financial advice. These are just some examples to show you how your test results could translate into an actual strategy. So let's say you have a high tolerance and a 20-plus year timeline. Maybe a portfolio with a big chunk in a KSE 100 index fund makes sense for you. For someone with a more moderate tolerance, maybe you'd pair that index fund with some solid, stable dividend stocks. And if you have a low tolerance or a short timeline, your focus should probably be on things like bank deposits or national savings certificates. The point is, your portfolio should look like a reflection of you.
And this brings us to what might be the single most important idea in this entire explainer. I want you to think of your investment plan like this. It's a contract. It's a contract you make with your calm, rational self that needs to be followed by your future emotional, panicking self. You write it down when you're thinking clearly, so you have a set of instructions to follow when fear is screaming in your ear, telling you to do the exact wrong thing.
So we've covered a ton of ground today. The big takeaway is that understanding yourself is so much more important than trying to outsmart the market. You've now got the tools, the 4 tests, to really start figuring out your own tolerance for risk. So I'll leave you with this final question to think about. You've started to understand your risk. Now, what's your first step going to be?